it's a newsworthy event for you all. Something not so newsworthy, I'm going to remind you that my remarks are mine alone, not necessarily those of the commission, the commissioners, or the staff. But this event gives us a great opportunity to address a topic that I think has been a subject of considerable debate in the press and in the crypto community, and that's whether a digital asset, a token, a coin, offered as a security can over time become something other than a security. To start with, I'd like to frame that question a little differently and focus not on the digital asset itself and does the digital asset morph into something, but let's look at the circumstances surrounding the digital asset and the manner in which it's sold. To that end, I think a better line of inquiry might be, can a digital asset originally sold in a securities offering later be sold in a manner that doesn't constitute the offering of a security? In cases where the digital asset represents something like an equity interest, looks a lot like an interest in an enterprise, has a financial interest in an enterprise, the answer is often going to be no. In those cases, a transaction, an initial coin offering or an ICO or the sale of a token, will not, calling it that, will not take it out of the purview of the U.S. securities laws. But how about those cases where there's no longer a central enterprise that's being invested in, or where the digital asset is sold only to be used to purchase a good or service on the network and on which it was created? I believe in those cases the answer can be a qualified yes. It might be something other than a security. And I want to share my thinking with you here today about the circumstances under which that could occur. Before I turn to the securities law analysis, let me share what I believe may be the most exciting thing about DLT, and that's its potential to share information, transfer value, and record transactions in a decentralized digital environment. All of us at the SEC believe that there's real value in creating applications that can be accessed and executed electronically with a public, immutable record, and without the need for a trusted third party to verify those transactions. We see the value in that, and we see the potential for that to create innovation. There's a great deal of excitement, there's a lot of speculative interest, and there's even some fraud. But I'm not here to talk so much about the promise of blockchain technology. Many in attendance here today and those who will speak after me can do a much better job of that. I would like to focus on the application of the federal securities laws to digital asset transactions. That is, how tokens and coins are being issued, distributed, and sold. While that might be a little drier than talking about the promise of the blockchain, that topic is critical, I think, to the broader acceptance and use of these novel instruments. So don't run for the exits, take a slug of your latte. We may have some news on how we're looking at these issues here. Before I begin describing what I often see, let me begin by describing what I often see. Promoters, the founders, sponsors, the folks behind these efforts, in order to raise money to develop networks on which digital assets will operate, will often sell the tokens or coins rather than sell shares or issue notes or obtain bank financing. In many of these cases, the economic substance of the fundraising is the same as a conventional securities offering. Funds are raised with the expectation that promoters will build a system, investors will earn a return on their investment, and they will usually do that by selling their tokens in the secondary market once the promoters create something of value with the money that they've raised and the value of the digital enterprise increases. When we at the SEC see that kind of economic transaction, it's easy for us to apply the Supreme Court's investment contract test, first announced over 70 years ago in the SEC versus Howey case. That test requires that there be an investment of money in a common enterprise with an expectation of profits derived from the efforts of others. Pretty straightforward. I think it's important to think about the facts of Howey. In that case, a hotel operator in Florida sold interests in a citrus grove to its guests and claimed it was selling real estate, not securities. While the transaction was labeled a real estate sale, it also included a service contract that would allow Howey and the Hill Service Company to cultivate and harvest the oranges on behalf of the purchasers. In looking at that, the Supreme Court saw a security, and they stressed, form is disregarded for substance, the emphasis is placed on economic realities. So a purported real estate purchase is found to be an investment contract. An investment in oranges, in these circumstances, was an investment in a security. So folks are looking not at the digital packet, At the coin, something other than a security, you look to the substance of the transactions. And in the ICOs that I have seen, overwhelmingly, promoters are touting their ability to create an application that's innovative based on blockchain technology. Like in Howey, the investors are passive, or often passive. Marketing efforts are rarely narrowly targeted just to potential token users. And typically at the outset, the business model, the very viability of the application is uncertain. The purchaser in these circumstances has no choice but to rely on the efforts of that promoter to build out the network, to make the enterprise a success. At that stage, the purchase of a token looks a lot like a bet on the success of an enterprise, not the purchase of something certain to be used to acquire goods or services on the network. As an aside, you might ask, given these token sales often do look like securities offerings, why are promoters choosing to package the investment as an ICO or a coin offering? That's an especially good question if the network in which the token or the coin is not yet operational. I think there can be a number of reasons for structuring it that way. For a while, some believe that this kind of labeling might by itself remove the transaction from the securities laws. I think people now realize that labeling an investment opportunity as a coin or a token that does not alone achieve that result. Second, there might have been hopes that this labeling could create some marketing sizzle for the enterprise. That might still work to some extent, but I think the track record on ICOs is still being sorted out. Some of that sizzle may now be more of a warning flare in some ways for investors. And then some, maybe perhaps more legitimately, are being attracted to the blockchain-mediated crowdfunding process. Digital assets can represent an efficient way to reach a global audience where initial purchasers have a stake in the success of the network, become part of the network, where their participation adds value beyond their investment contribution. The digital assets can subsequently be exchanged, sometimes in trying to find the market price for the value of this new application, other times in a more speculative venture. I do think, I was saying all of that some of the industry participants are beginning to realize that in many cases, it could be easier to start a blockchain-based enterprise in a more conventional way. We meet with industry participants all the time, and we're hearing that they sort of recognize the value of structuring things in phases, with phase one being done as an offering on a more conventional basis, either registered or exempt equity or debt offering. And then once that funding allows the network to get up and running, then distribute or offer blockchain tokens or coins to participants who need the functionality that the network and the digital assets offer. This allows the tokens and the coins to be structured and offered in a way where it's then more evident that the purchasers are not making an investment in the development of an enterprise. In other words, it's easier to make the case that the token at that phase is not a security. Returning to ICOs that we are seeing, strictly speaking, the token, the coin, whatever the digital information packet is being called, all by itself, we don't think is a security, just as oranges in the Howey case were not securities. Central to determining whether a security is being offered, however, is how it's being sold and the reasonable expectation of purchasers. When someone buys a housing unit to live in, it's probably not a security, but under certain circumstances, the same asset can be offered and sold in a way that causes investors to have a reasonable expectation of profits based on the efforts of others. If the housing unit is offered with a management contract or other services, and purchasers are encouraged to invest rather than reside, that could be a security. Case law tells us that. There are cases on that. Case law similarly tells us that when a CD, a certificate of deposit, expressly exempt from being treated as a security under Section 3 of our Securities Act, when that CD is sold as part of a program organized by a broker who offers retail investors promises of liquidity, a potential profit from the changes in interest rates, the Gary Plastic case teaches us that that instrument can be part of an investment contract that is a security. The Howey and the Gary Plastic case reasoning applies to digital assets. The digital asset, again, itself is simply code, but the way in which it's sold as part of an investment to non-users by promoters to develop an enterprise can be, and to that extent, most often is, a security because it evidences an investment contract. And regulating these transactions as securities transactions makes sense. The impetus of the Securities Act is to remove information asymmetries from promoters and investors. In a public distribution, the Securities Act prescribes information that investors need to make an informed investment decision. And the promoter is liable for misstatements in the offering materials. That's an important safeguard, and that's appropriate for many of the ICOs that we see, probably most of the ICOs we see. The disclosures required under the federal securities laws nicely complement the Howey investment contract element about the effort of others. As an investor, the success of the enterprise and the ability to realize a profit on your investment turns on the efforts of that third party. So learning information about the third party, its background, its financing, its views on the risks of the venture, its plans, what it will do with the funding, whether it has a financial stake and interest itself, how long will its interest take place. These kinds of things are a prerequisite for the investors in those coins making an informed investment decision. And without a regulatory framework that promotes disclosures of what the third party knows of those topics and what the investor might not know, without that, then there's going to be risks associated with that investors. Investors will be uninformed and be more at risk. So this points to the way, in some ways, also how a transaction might not represent a securities offering. If the network on which the token or coin is to function is sufficiently decentralized, and the purchasers no longer have a reasonable expectation that a person or a group is going to carry out essential managerial or entrepreneurial efforts, those assets might not represent an investment contract. Moreover, when the efforts of the third party are no longer key in determining the enterprise's success, material information asymmetries recede. So what I was talking about, what the third-party promoters know about but the investors don't know about, if this is highly decentralized, that information asymmetry recedes. As the network becomes more truly decentralized, the ability to even to identify a promoter or to make the requisite, and someone that could actually make the requisite disclosures becomes in many cases difficult or and perhaps much less meaningful. So when I look at Bitcoin today, I don't see a central third party whose efforts are a key factor in determining the success of that enterprise. The network on which Bitcoin functions is operational, appears to have been decentralized for some time, perhaps from inception. Applying the disclosure regime of the federal securities laws to the offer and resale of Bitcoin would seem to add little value. Moreover, putting aside the fundraising that accompanied the creation of Ether, based on my understanding of the present state of Ether, the Ethereum network, its decentralized structure, we believe current offers and sales of Ether are not securities transactions. As with Bitcoin, applying a disclosure regime, the disclosure regime of the federal securities laws to current transactions and Ether would seem to add little value. Over time, there may be other sufficiently decentralized networks and systems where regulating the tokens that function on them as securities may not be required. And of course, there will continue to be systems that do rely on central actors, whose efforts are a key to the success of the enterprise. In those cases, the application of securities laws protects investors who purchase coins. I should add that regardless of the applicability of securities regulation to the distribution of the assets, as our Chairman Clayton has pointed out, regulated financial entities may have other legal duties related to cryptocurrency transactions. There's a plethora of federal regulations that apply beyond the securities laws. The anti-money laundering, FinCEN rules, the Know Your Customer rules, the Commodities Exchange Act may be relevant, the IRS code, and of course state financial intermediary and money servicing laws all come into play. But I'd like to emphasize that the analysis of whether something is a security is something that we look at as not a static point. It doesn't strictly adhere to the instrument itself. We have to look at the circumstances. So when digital assets with utility function solely as a means of exchange on a decentralized network are repackaged and sold as part of an investment strategy, that could be a security. An example, if a promoter were to place Bitcoin in a fund or trust and sell interest, that would probably be a new security. Similarly, investment contracts can be made out of virtually any asset, provided that the investor is reasonably expecting profits from the efforts of the promoters involved. We understand that promoters and market participants want to understand whether their transactions in a particular digital asset involved in the sale of a security. We're happy to help promoters and counsel work through those issues. We stand prepared to provide more formal or interpretive and no-action guidance about the proper characterization of a particular digital asset and any proposed use. For example, we've been asked for our views on the SAFT, a simple agreement for future tokens. As I hope this speech makes clear, the legal analysis as to any particular SAFT must follow the economic realities of what's going on in that particular enterprise. And I believe a digital asset sold as part of a securities transaction may, depending on the circumstances, may be able to be resold as a non-securities transaction. But I expect that some, perhaps many digital assets, including those originally packaged as parts of SAFT, will retain the characteristics of a security for some time. But again, whether a network is at the decentralized state where tokens that trade on it might be viewed as something other than security is a fact and circumstances test, and one which we are prepared to help issuers and other market participants answer. Come see us. We also recognize that there are other implications under the federal securities laws of whether we call a particular asset a security. Our divisions of trading and markets, our investment management division, they're all focused on issues such as broker-dealer issues, the exchange trading of these products, fund registration, matters of market manipulation, custody valuation. All these issues come into play when we have a security that's captioned a coin. And we understand that market participants are working to make their services compliant with our existing regulatory framework, and again, we're happy to engage in that process. So you might ask, what are some of the factors to consider in thinking about whether a digital asset is being offered as a security, as an investment contract, and therefore a security? Primarily, we look at what's the third party doing, be it a person, an entity, a coordinated group of actors. Are they driving an expectation of a return? Again, the question is always a facts and circumstances one, but I wanted to just note a few things. This list is not meant to be exhaustive, but these are things that we look at. We ask, is there a person or group who sponsor the promotion and creation of the sale of the assets? And do they play a significant role in the development and maintenance of that asset and its potential increase in value? Has that person or group retained a stake or other interest in the digital asset such that it would be motivated to expend efforts to cause an increase in the value of the digital asset? When purchasers see that and they see that stake, do they reasonably believe that those efforts will be undertaken and may generate a return for their own investment in the asset? Has the promoter raised an amount of funds in excess of what might be needed to establish an up and running functional network? If so, has it indicated to investors how those funds might be used to support the value in the secondary market of the tokens or to otherwise increase the value of the enterprise? Does the promoter continue to expend funds from the proceeds for enhancing the functionality, or are they using it to just enhance the secondary market value? Are purchasers investing, seeking a return? In that regard, is the instrument marketed and sold to the general public instead of potential users for a price that reasonably correlates to the market value of the goods and services that the network will offer? Do the application of the securities law protections make sense? Is there an entity that others are relying on that plays a key role in the profit-making potential of the enterprise, such that disclosure of that entity's plans would be important and useful to investors? In other words, those information asymmetries I talked about exist between the promoter and the potential investors in the enterprise. And do persons or entities other than the promoter exercise governance rights and have meaningful influence? Or is this something run largely by the promoters? While those factors are important in analyzing the role of the third party, there are also other things on a contractual or technical way to structure digital assets so they function more like a consumer item and less like a security. Again, we would look to the economic substance, but promoters, their counsel should consider these and other possible features. Again, this list is not intended to be exhaustive. By no means do I believe each one of these factors needs to represent or establish a case where a token is not being offered as security. The list is meant to prompt thinking by promoters and their counsel and start a dialogue with the staff. It's not meant to be exhaustive. But things we look at include, is the token creation commensurate with meeting the needs of real users rather than feeding speculation? Are independent actors setting the price, or is the promoter supporting the market? Is it clear that the primary motivation for purchasing the asset is personal use or consumption as compared to investment? The purchaser's been asked to make representation about their consumptive as opposed to their investment intent. Are tokens available in increments that correlate with the consumptive versus investment intent thesis? I will stop there. I will note that the list goes on. We have published this speech on our website, and they are all there. I would encourage you to look at it. And again, no one of those factors is meant to be dispositive, but you should be considering all those as you're trying to structure coins. And if you're trying to eventually get to the point where it wouldn't be viewed as a security, I think all those factors will be relevant. So thank you very much.
Thank you, Bill, very much, and please join me and sit down. I just want to ask you some follow-up questions, and thank you for those remarks. And I'm glad that you said they will be posted, right, because there's a lot of detail there, and I think people will want to kind of look at that very carefully as some guidelines going forward. So let me just ask you some follow-up questions. So you mentioned Bitcoin, you mentioned Ethereum as well, and so is the takeaway that these are not securities then?
Right. I think the takeaway and maybe the news is more on the Ether side. Mm-hmm. I think for some time we've been treating Bitcoin as a commodity. It's certainly regulated that way by the Commodities Exchange Group, and we haven't disagreed with that treatment. Ether is, a coin that has been evolving. The network is evolving. We think when we look at how Ether today is operating, at least, we see a highly decentralized network, and we don't see a central third party where folks are saying, oh, if that person does these things, this will be giving me an investment return. So we don't see that key third party actor. We do see it being highly decentralized. The governance is decentralized. Things that occur on that network are very public. The developer conferences are very open. We don't see those information asymmetries. So what we're trying to say is we don't see a lot of value in treating Ether today as a security.
Fair for me to characterize this as a kinder, gentler assessment of cryptocurrencies?
I think you could say that, but I think the chairman and the SEC has been following this area carefully. They've been watching developments. I think we've been careful not to react too quickly or to overreact to things. And we, in the case of Ether, as we see it develop, as we interact with market participants who are engaged in Ether transactions, we keep gathering information. And at some point we say to ourselves, well, this is something that we should make clearer in its current state. We don't see value regulating it. So we're trying to be transparent and practical as we provide more guidance.
The SEC just announced the appointment of the first crypto czar who is reporting to you. Can you explain what that role is and what you guys are trying to accomplish?
Sure. Many in the audience may know Val Stefanik. She's been at the SEC for quite some time and is probably one of our lead technologists. Knows the space very well. She had a focus on the enforcement side, but her job kept evolving and she found herself doing more and more in terms of coordinating across the agency an approach that made sense to the overall regulation, not just the enforcement actions. And we saw the value of having Val in my division, the Corporation Finance Division, sort of more formally taking on that role and a broader role where it's clear that she's in part responsible for our fostering innovation here as well as making sure investors are protected. We're very excited about it. She's terrific, as many of you know.
And as part of that role, do you need a framework for the evolution of understanding how to regulate this incipient business, right?
Sure. Again, Jay Clayton arrived at the SEC about a year and a month ago, and I followed him shortly. And before we got there, it was not an issue that was high on securities regulators' minds. It really started to blossom and become something important. So we had to, figure out how could we protect investors at the same time, how do we not stifle innovation? And so, as you point out, it's incipient. It's been evolving. We don't want to react too quickly. We do want to protect investors. So we're picking our areas carefully and trying to do things that are thoughtful. I'm sure we'll continue to learn. We'll continue to refine. One of the reasons we want to look at these things on such a case-by-case basis is that the facts and circumstances make a big difference in a particular offering, a particular coin structure, and we don't think establishing a lot of bright lines at this point is really helpful. We think we could miss some things where investor protections are needed, and we could be over-inclusive and stifle some things. So we're trying to look at this facts and circumstances, and we encourage council and participants to come visit with us, which we do a fair amount, and sort this out together.
Are there other regulatory bodies besides the SEC who should be providing oversight for cryptocurrencies?
Well, I mentioned a number of agencies that do touch on the space. Basically, cryptocurrencies, the currencies in particular, and ICOs and coins, involve a whole host of other potential agencies. Commodities Futures Trading Commission significantly, because many of these have been viewed as commodities, Bitcoin in particular. We know and we do coordinate with the FinCEN folks in terms of the when it comes to anonymized tokens, the concerns that can raise. So the FinCEN, know your customer, anti-money laundering issues, there are IRS issues. There's a host of issues, systemic questions around if the financially regulated entities get more involved in this space, what will that do? We participate with a group organized by Treasury to sort of coordinate among the agencies, and we're trying to do that in a way, again, which balances investor and consumer protection with not stifling innovation.
Many of us would like to be a fly on the wall in some of those meetings, Bill.
Well, Val and I go to them, and to the extent we learn things that we can share, we certainly try to be transparent about. That's one of the reasons, again, we invite people in.
All right, we're going to leave it at that. Bill Hinman from the Securities and Exchange Commission, thank you very much for coming here today. Appreciate that. Give me this stuff. Thanks so much. Thank you. All right, coming up next, JP Mangalinden from Yahoo Finance with Keith Raboy. Great to see you guys.